Hello, and welcome to our PowerPoint presentation over the business simulation game in Industry 19. Our company is Best Foot Forward, and our co-managers are Lakeisha LaFleur and Shauna Moore. We gradually had an increase in net revenues up to year 15, where they were $806,833. After that, we had a slight drop from year 16 to year 18. In year 19, our net revenues increased back up to $888,878. We ended the game in year 20 with our net revenues the highest they had been at $1,079,961. I expect that our net revenues will continue to increase the next 2 years and continue on from that. Our earnings per share gradually increased as well. In years 13 through 16, our earnings per share was about the same as the investors' expectations. Year 17 was a slight drop to $5.76. From year 17 to 18, we had a huge drop that dropped us down to $3.22, and we stayed in that area in year 19 as well. In year 20, we jumped up to $6.56, and I believe we will continue to rise in the next few years. Return on equity fluctuated a lot. It went up until year 12 to 23.7% and stayed in that area until year 16, where it went up to 27.5%. It continued to increase until year 18, where it dropped quite a bit to 21.8%. In year 20, it jumped back up to 36.1%. A 14.6% increase from year 19. We had a really tough time with our credit rating. The highest we got was an A- in year 13. After that, we bounced between an A and B+ until year 17, where we dropped to a C+. In years 18 and 19, we dropped to a C-, and in year 20, we had a slight jump back up to a C, and I believe in the next few years we can at least jump to a B or B+. Our stock prices rose up until year 14, where it had a slight drop and continued to drop until year 16. In year 16, our stock price was the highest at $93.15. After year 16, our stock prices fell all the way to $20.12 in year 19. In year 20, we increased our stock price back up to $59.23. We had a really tough time keeping our image rating up. We only met investor expectations 4 times, with an image rating of 79 being the highest in year 15. After year 15, we continued to drop down, and we were at the lowest in year 20.
Our goal at Best Foot Forward is to maintain steady growth in the global market while maintaining our stockholders' profit margin and to provide our customers with quality shoes in a variety of styles while still keeping the prices affordable. Our performance targets at Best Foot Forward for year 21 and 22 is to increase our annual earnings per share in year 21 to $9 a share and increase that a little more in year 22 to $11 a share. We would like to have our return on equity in year 21 to reach 40% and our goal for year 22 is to increase that even more to 45%. Our credit rating fell to a C average in year 17, and we hope to improve on that in year 21 and get a credit rating of a B minus, and then increase that a little bit more for year 22 to a B plus. Our image rating declined in year 15 and has steadily declined since. We want to increase that image rating to a 68 in year 21 and increase it a little more to a 70 in year 22. Our strategy in the internet market was to keep our shoe quality above average and making sure we weren't the highest priced in the industry. We also watched foreign exchange rates and tariffs, and we started to increase our advertising, especially in years 18, 19, and 20. In the wholesale market, our strategy was to increase our brand advertising every year, increasing our customer base. We also paid attention to our retailer support. We were consistent in that support so that our retailers would still carry and promote our products. With the private label, we made sure to keep the private label throughout the entire game. We always offered private label shoes. We increased our pairs that we produced and shipped each year, and we made sure that our prices were consistent with wholesale prices. In production, we remained consistent every year. Every year, our employees received a raise. We kept up with their training. We always committed to best practice training, and we focused on making sure the money was there to improve working conditions every year consistently.
Throughout the simulation, we aimed to meet investor expectations and deviate from that where we saw was necessary. We tried to be very aware of exchange rates. We would also pay off loans in a timely manner to control costs. We would also avoid negative cash balances such as overdraft loans and interest expenses. We would issue stock to pay down accumulated debt, as well as repurchase stock when possible to increase dividends. Our dividend policy was, when feasible, pay out the appropriate amount of dividends without creating a negative ending cash balance. We would also decrease dividends when earnings were less expected than the year before. In the next 2 years, we estimated our stock price to go from $59.23 to $80 in year 21. From then on, we estimate it to go up from $80 to $100 in year 22. Our competitor in the internet market was FunRuns. They were higher overall in the North America segment. Their retail price was higher than ours by $5.50. Their SQ rating was 0.2 above ours. They had $2,000 more towards brand advertising. They were mostly lower than us in the Europe-Africa segment. Their retail price was higher by $6.50. Their SQ rating was the same as ours at 5.6 stars. They didn't use any search engine advertising or brand advertising. In the Asia Pacific segment, they did not use any search engine advertising, but spent $26,500 on brand advertising. In the Latin America segment, they did not use any search engine advertising nor brand advertising, but they did offer free shipping. Fun Runs was also our competitor in the wholesale market. They were higher on everything except retailer support in North America because they chose to not use any retailer support in that segment. In the Europe Africa segment, they were lower on everything except wholesale price. They were $4.75 higher on their shoe price. We were fairly even on everything in the Asia Pacific segment. They were also lower on everything in the Latin America segment except for wholesale price. They were $4.75 higher in that segment as well. We had two competitors in the private label market, Fun Runs and Soulmates. Fun Runs was lower in price, higher in SKU rating, and had less pairs available and sold in the North America, Asia Pacific, and Latin America segment. They did not sell any in the Europe Africa segment. Soulmates had lower prices, the same SKU rating as us, and less pairs available and sold in all four segments. We had the highest pairs available and sold in each segment.
In the internet competition, we had a steady growth rate in our retail price, our model availability, our brand advertising, and our celebrity appeal. And we gradually improved on our search engine advertising, our SQ rating, our brand reputation, our online orders, and our market shares. In the wholesale competition, we showed a steady increase in wholesale price, our model availability, our celebrity appeal, the pair of shoes that we had in demand, and our market share. We improved in the SQ rating. We increased our rebate offers, our delivery time, and our retailer support, which increased our retail outlets, brand reputation, and stocks. In the private label competition, we bypassed the competition by consistently using our private label as much as possible, which kept production steady, had an increase in our offer prices, our SQ rating. We kept our pairs available and pairs sold up, and our market share steady. This game simulation taught us a lot. A few of the lessons that we walked away with was one simple change can make a huge difference on your outcome. The changing of one number changes everything for the company. You don't even realize it sometimes, and it just sends everything into a mess. You really need to analyze and pay attention to what your competitors are doing, what they're choosing that's making their company perform better than yours. Use those ideas and try to adjust your thoughts. Communication is huge. We ended up with just the two of us, but co-managing is big, and you have to communicate. We spent hours throughout this semester on the phone, texting, online, but communication is big. You have one co-manager who wants to change and go a different direction, and if you go on there and start changing numbers, it totally messes everything up. And the same thing, if you want to try a different direction and you change numbers and your co-manager wants to put everything back, it can get to be a real struggle. So communication is the key in this simulation. It's definitely big. We also needed to work a little bit harder on our celebrity endorsements. We didn't focus on that a lot, especially early in the game, but it definitely affected us in the latter part of the game. You need those endorsements. That's what gets your name out there. It's just like real world endorsements. When a celebrity talks about a product on social media, everybody wants that product. They pay attention to that product. They know that product. So we failed to really focus a lot on our celebrity endorsements, and that was something that we definitely needed to focus more on. We also learned that playing it safe and staying in your comfort zone isn't the best choice later in your game. We spent the first part of the game kind of comfortable, playing it safe, not jumping out and making big changes, which was fine. It kept us in the middle of the scoreboard. But in year 17, we jumped out of that comfort zone a little bit, didn't play it quite so safe, made some different choices, and our score just fell. We fell towards the bottom of the scoreboard, and it's hard to jump up, especially when we had spent so many years not making big changes. So you really need to step outside that comfort zone. Don't play it safe. Big learning experience. We also learned midway through the game that the quality of our product is more important than our quantity. If we have a quality product, it sells. We can have more production of a less quality product, but we're going to have more rejects and products left unshipped. This game was definitely challenging. We had very many moments when we were high anxiety and stressed, but we got through it. The big key again is communication. I think that's one of the big lessons that we learned is how important communication is. But everything else aside, I hope that you enjoyed our presentation from Best Foot Forward. Thank you.